Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, today we're going to be looking at the SPY, we're going to be looking at the Nasdaq as well, we're also going to have a look at the VIX and the PCC. But before we begin, do you want to learn Elliott Wave Theory? Well, if so, consider joining the Green Star Trading Patreon at either Tier 2 or Tier 3. You will unlock this 11-part series, which is a comprehensive yet easy to follow video format, teaching you everything you need to know about Elliott Wave Theory. Well, maybe you want to learn how to chart the way I do as well. Well, I have a series called My Chart, which is an ongoing series which I'll be adding to every month over the coming months, which covers exactly how I set up my chart on TradingView, every tool I use, every drawing I use, every object, every indicator, the whole lot. And we'll show you how to set it up the way I set it up. You don't have to do it this way, of course, but if you're interested, there'll be a dedicated playlist of this too. And finally, maybe you just want to learn how to trade the way I do with my technical methodology, using what I call the standard trade setup. There's a playlist here for that too. We also cover things like trading psychology and risk management. If all of this sounds good to you, then you can unlock all of it by clicking on the link in the description box below, heading over to the Green Star Trading Patreon page and joining Tier 2 for £10 a month. By doing so, you will unlock all of the playlists I've just shown you, as well as a whole raft of other educational content. You'll also get access to the public Discord, where there is a myriad of channels covering multiple subjects which can keep you engaged and in discussion with all the other members of our community, including myself. I also host weekly live streams which can go on for hours at a time, where I'm happy to take suggestions and cover anything anybody wants to look at, as long as they make the suggestion in advance. But if all of that isn't enough for you, then maybe join Tier 3, where you get every single benefit I've just listed, but you also get access to my monthly dividend calendar and stock rating system. Finally, if neither of these appeal to you and you just want to support the channel by donating £5 a month and appreciate the work I'm already doing on YouTube, you still bag yourself an exclusive video each week. Thanks for listening, guys. We look forward to having you on board. Now let's get back to the video. Okay, welcome back, guys. Right, we're going to start here on the SPY on the daytime frame, and we're going to start with a bullish count, and we'll look at a bearish count as well. As the market may have bottomed, may not have bottomed. We're going to look at the evidence as always and decide our preference. I've already decided mine. Doesn't mean I'm right, of course, but either way, let's have a look at it. I want to start by just taking off the count for the moment. Actually, I'm just going to gather up these price labels I've got here, and I'm just going to label these bullish invalidation. Nice simple levels that if we break them, this bullish count is wrong. That's that. We'll talk about that in a bit. Let's get rid of this primary 1 count. And yeah, we don't need the previous count on either. So let's just have a look on the daytime frame at our moving averages and our momentum indicators. So since the March low 2020, we moved up through the 10 through the 20, 10 and 20 through the 60, 10, 20 and 60 through the 250, back tested the 60 on it, and since then we've stayed above. We then came back for the first time since then, since crossing in March 2020. From a 2020 low, we came through in June 20. Since then, we have not tested that 250 exponential moving average. Okay, until recently, where we came down to it and even broke it, came back with a higher low. So we've had our first real significant breakdown since this bottom. Okay, we're going back 2 years now, so it's 2 years since we bottomed. It may sound like a long time to some, it feels like 5 minutes to me. So that suggests to me that all of this was one move, and this significant test of the 250 is the first real pullback we've had. Okay, now you might say, well, that was a pretty big pullback, and this was, and I'd argue no, they're not. I'd argue that was a significant pullback. The March 2020 COVID crash, right? I'd argue that this is the most significant pullback we've had since, and therefore stands to reason that this is a 1 and this is a 2. Now it looks short, it looks sweet, and it looks like it wasn't very deep. Well, that's very much the case for wave 2s over the last 12 years of this bull market. It could be part of a much larger corrective structure which is going to play out lower. These are possibilities, right? But since we're covering the bullish count first, let's talk in that sense. So now let's look at the 4-hour time frame and how this 250 exponential moving average works as very reliable support and resistance. So support, 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 break it, resistance, and we're currently back at it. So I will give the bears the opportunity here. This is a possibility that if they're going to turn us back around, this is a bloody good place to do it, because support and support often becomes resistance. Horizontal levels, channels, trend lines, and in this case frequently seen moving averages, right? And the 250 is a major one on this time frame, on the 4-hour, just as it is on the day time frame, week time frame, so on and so forth. So if we're going to get turned around, this could be the start of a little pullback before breaking higher, or it could be the top of a 3-wave corrective move before heading lower. That's the bearish interpretation. But now let's bring up our technical indicators for the MACD and the RSI. Now what I find interesting here that I want to point out is this is when the war breaks out, okay, which may have been the bottom. Contrary to fundamental worries and concerns and analysis and genuine sentiment, which is war bad, market lower, we may have actually bottomed when it all kicked off and have since, as things have gotten progressively worse, moved higher. Right. It seems counterintuitive, but markets tend to be that way. Now, I'm not saying it's a guarantee, but I just find it interesting. What I also find interesting is during the breakdown of this move and the suspicion that things could kick off, pardon, I'm not in any way undermining or what's the word, discounting the seriousness of the conflict that's going on in Ukraine. My heart goes out to everybody over there who's struggling and suffering as a result of this terrible conflict. However, before things kicked off, and it looked like they were, we actually put in an extremely strong bullish divergence preceding the start of hostilities. And we can see how as this bullish divergence builded up, the catalyst for it to launch pad was the start of these terrible hostilities. So it's just one of those things where, you know, the market often does the exact opposite, sometimes to the day, to the hour, to the tick, but people expect it to do something else. Just an observation. Okay, so coming off the back of very strong bullish divergence, lower lows, higher lows, same in the MACD, lower lows in price, higher lows in momentum. One thing I want to point out which supports the idea that this was the first real significant breakdown of a new trend higher is the histogram on the MACD. So let me show you what I'm talking about here. Let's put a horizontal line across the peak of the histogram now. So here's the histogram. Really powerful move off of the low here. Right. It could be topping out before we go lower. It could only just be getting started. Right. Now the average is back to the zero bound. We're dragging the signal up behind us. So we're back into positive territory on the MACD just for the first time since 14th of Jan, where we crossed into negative territory. We haven't seen a move with this much oomph behind it, pardon the simple expression, since the March 20 lows and the leading into the initial rally off of those lows. Everything since has been less impressive, essentially. So this is another strong sign, strong bullish momentum, big thrust back into positive territory, growing histogram, right? Look at how the negative momentum, right, was reducing, drawing this divergence. Histogram shrinking, now growing, right? This was a preceded I was about to say precedent, that's not the right word. This is a sign of what was coming, okay, that we were going to pop, and that's exactly what we've done. Now it wasn't a little pop, right, these, right, or any of this. It's a big pop supported with strong divergence. So you can hear what I'm saying. that makes me lean into the idea that it was a significant low. Right. We put in a significant low and came off of it strong. Right. So that's the basic technical analysis sorted there. I just wanted to get that out of the way first before we come in and have a look at the count, because some people are just finding it hard to believe at the moment, and I don't blame you at all for thinking it's hard to be bullish at the moment. I get it, and it might not be, as I pointed out, but there is evidence for it to be so. Okay then, so let's now bring up our primary count. To explain this, we're going to need our bullish invalidation levels as well. So bullish hat still on before we consider a bearish alternative, for which there is one. We have two clear invalidation levels down here. This is based off the idea if this is 1 and this is a double zigzag into 2, then this first limit at 410.65 is the cutoff. If we go through that, it's wrong. End of story. This is a nesting idea of a 1-2, right? So if we go through 415.12, this is wrong. Nice and simple. It does irritate me that there are some genuinely mean people out there, and I'm not being overly sensitive or a little bitch or anything like that. I just find it irritating that there are people out there who would happily see other people get hurt and suffer just so they could be right. Alright, it wouldn't be the first time I hear somebody say, oh, you got long here, bro, you're going to get wrecked. Look, if you're trading responsibly, if you're setting your stops correctly, if you're managing exposure and risk correctly, you ain't going to get wrecked for taking a trade when you think you should. End of story. And people who go around telling other people that they basically hope that they get wrecked so that they can be proven right in their bearish or bullish thesis, you guys are pricks. You're shitty human beings, putting it simply. Alright, so take offence if you want, I don't care. Spam my comment section, calling me an idiot for being bullish, I don't care. The only people who are wrong are you guys. End of story. So I've got that off my chest. Sorry to get a bit emotional about that, but let's just move on from here. So we've seen the idea that this is a possibly bullish count and that we've bounced off of a low. We've got an invalidation point in case it's wrong, and I see this as a double zigzag. Let's come down to the 4 hour. Now let me show you why that is. I see 3 waves here, not 5. So I can't say A. It's 3 waves. I could have said A, B, C, 1, 2, or 3, 4 back then, I think my count was, and then we come out of here in 5. Well, we didn't come out of here in 5, and we came lower. So it wasn't a single zigzag. I see another zigzag here, not 5 again. So I see a zigzag and a zigzag. So W, X, Y. Is there a way of getting higher before coming lower? Of course there is. It's called a flat pattern, and we're going to talk about that in a minute, and we could use an ABC rather than a WXY with an expansive B wave flat for the B wave. I'll show you that. So it's not necessarily all bullish from here, but why wouldn't you treat it as though it was at the moment? That's all I'm saying. I'm going to stick with the bullish idea here until proven wrong. So let's talk about how we could be proven wrong. Turn off the bullish count. Turn off these bullish invalidation points. Right. There are a couple of other bullish counts as well, but I put them behind that one in terms of priority. Maybe we can look at one in the Nasdaq in a minute. So here's a bearish idea. Let's go with a flat pattern. Now this says we're going to go higher before we go lower. Right. And we can go A, B, C, A. A, B, C, B. This would be 5 waves in the C of a B. A flat pattern within the B of a larger flat pattern. See what I'm saying? I'm saying 3, 3, 5. That's how we could get lower and still go higher. In other words, this is free real estate, right? Because this here, you can't have a flat until you get to 90% retracement of the high. So you got no worries in here for the moment. So buy pullbacks would be, it's not financial advice, but trading the pullbacks would make sense. Okay, so while these invalidation levels here hold, and we are not yet at 90%, you could have play in here either way. Right. Once we get to 90% be on the lookout for a reversal, because this is possible. And if we do reverse from here, maybe it's 5 waves up to here, right, rather than all the way up here. And then we start our 5 leg down. That's possible for a regular flat. Expanding flat is more common, that's why I put the target higher up. It's just more common than a regular flat. Okay, so that's the flat pattern. Now let's look at a more bearish pattern in the short term. Now this one looks way better on the Nasdaq than it does here on the SPY, but I'm going to share you it on the SPY first, and you can scoff at it if you're a bull. You're totally allowed to, just as you've probably been scoffing at my bullish ideas if you're a bear at the moment. So we had a diagonal down into an A, but it was a funky fucking A. Pardon my language. My little kid's probably home from school. I hope she didn't hear that, or she'll be in here wagging a finger at me, telling me off, and rightfully so. Shows a lack of vocabulary, Tom. So there's 1 as a zigzag, 2 as a zigzag, 3 as a zigzag, 4 as a zigzag, and 5 as a zigzag. Here's the problem with it, though, guys. Right, the 5 truncated before the 3, and the C of the ABC truncated before the A. It ain't pretty in order to get that as a 3-way move, and it ain't pretty to get it as a 5th because it truncates as well. That's the best I can do. It plays much more cleanly in the Nasdaq though. So if this was the case, a 50 to 61.8% pullback from the 5th, not from the 3, is a potential resistance point. And where does that happen to be? Right here, 448.12. Right. Actually, I think it's a little high. Let me just be absolutely precise. It's a daisy. 447.89 apparently. I must have mismeasured it slightly. Well, it's 448.12. Either way, that could be resistance here at the 50. Now we know the 250 exponential moving average is here on the 4 hour as well, right? We know we're retesting previous support, right? We've got in here support resistance. So we're at a level where we could find resistance. The 61.8 is higher, and that could be a likely pullback for a B, and then you come down in 5 and you've had a diagonal 3-wave B, 5-wave impulse 535 zigzag ABC, giving you a deeper correction. If you like the look of that, that's cool. Just bear in mind how messed up the completion of the diagonal was. Really messed up. Alright, so there's the counts that I see at the moment. Now the bullish alternate is that we're in the primary 3-4 with 1 move left in the 5. I'm not a big fan because the relationship of the primary 2 to the primary 4 is all fucked up. It's way deeper than it's not way deeper than it should be. It doesn't invalidate. It just doesn't look right. 2 is very shallow. 4's bigger. It just doesn't look like it belongs to the same wave degree. That's all I'm going to say. It feels like a larger move, a larger completion. Even less likely is the idea that it's an extension into an intermediate 4. And then we've had a small primary 2 and an intermediate 4 of a primary 3, which is larger in scale than its primary partner. That seems even less likely. So in the meantime, I'm just going to stick with the idea that we've done a primary 1, short and sweet primary 2. It could be a longer winded primary 2, right, which is going to have to take us all the way up and all the way back down to get 1, 2 deeper. Or it's the bearish idea, in which case I'm still sticking with the primary top, right? But we're going to go deeper, and we're going to go A, B, C, like that. Those are the best counts I see at the moment, and until I see these lows with the bullish invalidation get taken out, or I see the 90% level for a flat, I'm going to stay bullish in the meantime. Okay? And that's that. That's how I see the SPY. So the only thing we need to talk about in the Nasdaq will be how that diagonal pattern looks better. Everything else is basically the same. But before I do that, I just want to touch on one other subject for a moment. So here's a rare foyer for this channel into fundamental discussion as opposed to technical. Okay. One of the arguments which has been thrown at me constantly for any bullish count I come up with at the moment is that we're in a rate raising cycle. So firstly, I'm not 100% sure, far from it, that the Federal Reserve or any other central bank has the means or the balls to really try and tackle what they misinterpret as demand driven inflation. I don't think they have the tools or the balls to do it anyway. I think they've gotten scared before, just like back in 2018 when the market crashed into Boxing Day at Christmas holiday, and they panicked, switched off all the rate hikes, turned the QE back on up to full, and off we went to new highs. Right? Market crashed because of COVID in 2020, and what was the response then? I think I've seen a pretty clear pattern for the last 12 years, which is we are going to, having unlocked the unlimited money cheat code and put it into our little console using the up and down and A, B, C and so on and so forth, and now we've unlocked the unlimited money cheat, we're going to continue using it. There's no reason to turn it off. Inflation is the destination, not deflation. Okay, 12 years of lax monetary policy and absolutely irresponsible fiscal policy has made it pretty clear to me what the game plan is. The game plan is endless money creation. So let me give you an idea of how this is being misunderstood. So somebody was arguing with me the other day, and I brought this up in a live stream last week. It wasn't the person in the live stream who was arguing with me. It was a friend. But either way, they've been telling me for years that the DXY, which is the US dollar index, is going to collapse because of all the endless money printing in the States. And I pointed out the obvious, which is the United States has printed trillions upon trillions upon trillions upon trillions upon trillions of dollary dues, and the DXY is strengthened, has gone up. It's only gone in one direction, it's gone up. Dollar's gotten stronger against all of the fiat currencies. Does that mean that the dollar is worth more today? Absolutely not. Just look around you. Okay, a dollar today buys less than it did back in the bottom in 2009 of the DXY chart, even though the dollar's stronger. Right? The dollar buys less real estate, that's for fucking certain. The dollar buys less commodities. The dollar buys a hell of a lot less of the S&P than it did. Right? Or the Nasdaq. So you see the point. The endless money printing does not weaken the dollar against other fiat currencies. That's a complete misnomer. And I don't understand how anyone could think that. Because the dollar is the reserve currency of our entire species. Okay? It's garbage fiat, but my god, it has a massively privileged position over the rest of the garbage fiat crap out there. Okay? So if you're hoping for the dollar to weaken against the yuan or the yen or the pound, you're mental. It's not going to happen. All it's going to do is get stronger. That's all it's done for 12 years. It's all it's going to continue to do. Right? And you're not mental, but you've got the wrong end of the stick, in my opinion. If you're expecting the dollar to just be weaker in terms of its buying power, that's fucking obvious. Or just look around you at asset inflation, real estate inflation. It's everywhere. Right? And now it's an actual problem because we don't have demand-driven inflation, right? People are not running around with buckets of money that they need to get disposed of. Okay? This is a supply shock that we haven't gotten over, and it's getting progressively worse, and it's been made considerably worse by stimmy checks, fiscal policies, stimulus programs, all this money printing on top of it, right? Furlough in my country, in the UK, blah blah blah. The point is that it's artificial demand that's been created by government stimulus, and it's on top of a supply shock problem. That's the inflation that's getting out of control. You are not going to curb that inflation, whether it's 8%, 9%, 10%, or if you follow the shadow stats figures, 15% or higher. You are not going to curb that with a 2.5% rate increase, are you? If you want to beat inflation, you've got to get out ahead of it. If it's demand driven, you've got to get out ahead of it. So if you've got 5% inflation, you need 6% rates, or at least 5% rates. You need to cancel out, right, the inflationary effect upon the currency. So you've got to get out ahead of it. 2.5%, or however many little 25 basis point rate hikes they slap in the next 18 months, it's not going to cancel out 8%, 9%, 10%, 50% inflation, is it? Not even close. So it's lip service at best, in my opinion. So if you're banking on those being headwinds for equities and real estate and all the other markets, and you're a deflationist, I think you've got the wrong end of the stick. Because policy is clear as a bell for the last 12 years. The unlimited money cheat has been unlocked. The printing is never going to stop. Any problems which come along, we were 180 away from them because we're too terrified of the consequences. So that's that. Now, I could be wrong. I'm going to hold my hands up and say, of course I could be wrong. This is not financial or trading advice. But it looks like a pretty clear pattern to me. So would you want to be in cash in this environment, or would you want to own stuff? I want to own stuff, because cash, if you believe even the lowest figure of inflation, is evaporating at 8% a year. If you believe the real figures, it's way worse. And if you are in cash, what denomination are you going to be in? The dollar. The dollar. Because it doesn't matter how insanely irresponsible the United States government is, it's better than all the other fiat currencies out there, and it's proven it over the last 12 years. So why would you argue with reality? So that's that, guys. That's just my opinion. So pullbacks, long term, the market could pull back 10% from here, 20%, 30, 40, 50% from here. But why would the playbook change? Why would the policy change? It hasn't at any point to this point. Every hiccup, every bump in the road, every trough has been met with the same approach. There's no reason for that to end, and inflation and fear of inflation is not going to be sufficient to change it, because it can't be beaten. It's too late. There's too much debt. There's too much leverage. There's too much exposure. You cannot get ahead of this thing now. It's too fucking late to fix it. So there's only one way we're going. And that's my opinion. Now, I'm sorry if you don't want to hear that, or if you feel I shouldn't be talking about fundamentals. That's fine. I very rarely do, but I just wanted to get that off my chest. That's how I feel about the situation. Alright then, let's move on and have a look at the Nasdaq now. So, here's the primary 1, 2. Same as in the S&P, except we don't have this nesting 1-2 pattern because we get a lower C. Right, that's why I left that option open in the S&P, because it could be one way or t'other. Right, so we're done, and now we're going higher. Right, that's one way of looking at it. We get the same bullish divergence, very strong. Okay, here in the MACD as well as in the RSI. We've also got the highest readings in the histogram since back in March 2020, again here in the MACD. So another sign I feel that it was a significant low. Right, we fell further in the Nasdaq, gave up a little bit more. Tech got hit harder than other sectors did, but it could well be over. Right, so that's the bullish count. That's the same as the S&P, except we get this slightly lower low with the C here, so we don't get that nesting pattern. But other than that, it's the same. Now, if we move on and have a look at that diagonal I was talking about, right? This one plays a little cleaner from a bearish perspective, because we get a 1 and a 2. The 3 is shorter than the 1 for a contracting diagonal, the 4 is shorter than the 2 for a contracting diagonal, and the 5 does actually go beyond the 3, but it's still shorter than the 3, so there you go, legit Diag. Much nicer looking than we saw in the SPY. However, the truncation here, right, at the top of the market, the truncated fifth is not present in the S&P, it's present here in the Nasdaq. So that being 3 waves here doesn't work out as well as simply getting this to be 3 waves, and in order to do that we have to settle for a truncation up here, 3, 4, 5 into a truncated fifth. Now I can live with that, that's okay. Alright, slightly different from a SPY, but we saw weakness in tech earlier than we saw it across the broader market, and we got lower lows in tech than we got across the broader market, so it kind of fits. Earlier weakness, bigger breakdown, right? So in this sense, a 50 to 61.8% pullback from the top of the fifth here, not the top of the actual market, is what we would be looking for. So let's just move this. Now that was to mark the idea of it being in a different position. That's no longer relevant. So we're just going to move this up to here. Okay, now lock these in place. Alright, so that's 50%. So come up to here, find resistance, come back down. Maybe make it to the 61.8 and then come back down. A, B, C, deeper, 1 and 2. Not my preference. My preference is still for it being over as a 1 and 2 here, but that would be my second choice, ahead of the other bearish counts, which I think are less likely. So my primary is bullish, My alternate is bearish using this diagonal pattern. The reason I'm choosing it as a bearish alternate is because it doesn't play nicely in the SPY with a truncated C of an ABC in the fifth and a truncated fifth to the 3 of the diagonal A. All of that is a bit ugly, right? I would then argue that the flat pattern should be the next consideration. So if we come up 90% and then start to sell off, there's an argument for this being a larger flat pattern of a larger correction. Okay, so I don't really see anything else to talk about here in the SPY. It's the same count, guys. So, you know, that's the other count I had, which was 3-4. As I mentioned, I don't like it. I prefer this 1-2. 1-2 is either done or it's 1-2 deeper, one way or another. Whether we get that large flat into a 2 or whether we get that diagonal continuing lower after a B wave. They're the two ways I see the stock market playing out, but I'm going to side with the bullish pattern for as long as I'm moving the entire count, excuse me. I'm going to go with the bullish pattern until, or unless, sorry I should say, this bullish invalidation point here at 13.018 spot 87. So that's the Nasdaq. Right, then a quick wrap up now looking at the VIX. So rising trend line in the short term, 60s crossed through the 250, heading higher, starting to lose its steam now and roll over. If this trend line breaks, we can expect it to come back down and retest this rising trend line that goes all the way back to 2017. If we bounce from here again, then we can see how it affects the market and if our bullish invalidation levels break. But for the moment, we do have a rising uptrend. We are channeling slightly, although we did set a lower high here, so that could be the first sign that we've completed a move up and we're now going to start having a move back to this longer term trend line, and that gives us a fair bit of time until the next spike is likely to occur. So also if we look at the PCC, we can see we had the extreme panic back here in the COVID collapse, right? Back into April 20, we then ran into new levels of extreme greed and complacency. But as you can see, it takes a fair old while to get back to extreme fear. You know, several years in most cases. And I think, you know, having set those new lows in extreme complacency and greed, we're now going to just work our way up. And then once we get back into this extreme fear and panic, you know, that will probably be the next significant buying opportunity. I mean, this was a potential buying opportunity because you see you've got these levels here, right, where you have spikes into this kind of territory and then you pull back, right? See, and we're at kind of that point now, so we could be pulling back for a bit, heading back towards complacency. Okay, but the day's going to come when this is eventually going to get to a really scary point again, and that will represent the next really big low in the market, the next really big buying opportunity. Yeah, it could come up if we carry on breaking down now, right? If we are bearish, not bullish, and we have that diagonal, then we get a 3 in the stock market, we collapse, and we have more fear. That could be the next big buying opportunity, but we're still moving up at the meantime. So there's something out there, something big and scary that is going to happen, but generally fear overall is in decline, and greed and complacency, as you can see, is on the increase. So you could probably channel this. Yeah, all I've done is taken the moving averages here to display it, but you can see the trend is pretty clear. Right? The trend is downwards, right? Very subtle, but it's there. Yeah. Over time, we gradually become more and more complacent, less and less scared. You know, I guess that would be a really overly simplistic way of looking at it, but you know, it does tend to sum up the participation in the markets, I guess. Anyway, that's everything I've got for you today, guys. I know it's been a bit of a long one, and I went off on one for a while there with a rant, and feel free to comment on that if you want, or ignore it if you don't. I'm not one to waste my time much with fundamentals nowadays, to be honest, because everybody has an arsehole, and therefore everybody has an opinion. You know, and you could argue forever about monetary policy. The fact of the matter is, the people who are supposed to understand it, the experts, they don't even understand it. So what hope have we got, right? So anyway, that's my opinion on the stock markets, and I'm sticking with the primary count in the meantime until proven otherwise. Right, if you're new to the channel and you like what you're seeing, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below. If you are interested in joining the Patreon, there's a link in the description box below. Head over, have a read, see if there's anything you'd like, and if you want to join, please join. I would consider maybe start thinking about leaving it to the start of next month now, so you get a full month's worth for your monthly payment rather than the rest of this month. And if you're not following me on Twitter yet, please do so, as I always announce the new videos on YouTube on Twitter. Alright guys, take care of yourselves. Big thank you to my patrons as always, and I will see you later in the week. Bye bye.